Hello there, beautiful people. Welcome back to my channel. Today we're tackling one of the most common questions I hear from clients, friends, random people, and even fellow real estate professionals. Why do home loan interest rates go up when the Fed cuts interest rates? It's such a great question, but let's be honest. How many times have you heard the same old answer? Something like, oh, it's because of the 10-year Treasury yield. Duh. And then the person who asked just nods along, pretending to get it. But you can tell they're thinking, wait, what does that even mean? Here's the thing, I bet that a good chunk of people giving you that answer don't fully understand it either. And that's exactly why I'm here today, to give you a real comprehensive answer in plain, easy to understand language. This way, not only will you get it, but you'll also be able to explain it to anyone, your lender, your realtor, or even your skeptical Uncle Bob at the next family dinner. And hey, if you're working with someone who can't explain this clearly, maybe it's time you give me a call. I'd love to help you find your dream home and connect you with a lender who is one of my trusted financing partners to make the process as smooth as possible. All right, the short answer to this big question is this. It's all about how the Federal Reserve, the 10-year Treasury yield, and mortgage rates are connected. Sounds complicated. Don't worry, I've got you. By the end of this video, you'll feel like an expert and you'll be way ahead of the game. So let's break it down step by step. All right, let's start with something you might have heard in the news. The Federal Reserve cuts rates. What does that even mean? Here's the deal. The Fed controls something called the federal funds rate, which is basically the interest rate that banks charge each other to borrow money overnight. This is a super short rate, and the Fed changes it to help the economy grow or slow down. If the Fed lowers rates, it's likely stepping on the gas pedal to make borrowing cheaper and encourage spending. If it raises rates, it's like pressing on the brakes to slow things down and fight inflation. Sounds simple, right? But here's where it gets interesting. The rates doesn't directly control your mortgage interest rate. So why don't mortgage rates drop when the Fed cuts rates? Here's why. Mortgage rates are more influenced by the 10-year Treasury yield. This is the interest rate the government pays when it borrows money for 10 years. Mortgages are long-term loans, so the lenders use the Treasury yield as a guide for setting their rates. Now here's the tricky part. The Fed's actions still influence Treasury yields, but not always in a direct way. Let's break it down further. Sometimes the Fed cuts rates, and instead of mortgage rates dropping, they go up. Crazy, right? Here's why. Number one, inflation expectations. A Fed rate cut can make people think inflation will rise in the future. Lenders don't like inflation because it makes money worth less over time, so they raise mortgage rates to protect themselves. Number two, economic optimism. When the Fed cuts rates, it's a sign that they're trying to boost the economy. Investors believe it'll work. They sell safe investments like Treasury bonds to invest in riskier options like the stock. This pushes Treasury yields and mortgage rates higher, obviously because they're taking money out of the Treasury yield and putting it into the stock market. Number three, market risk premiums. If the economy seems uncertain, lenders might charge higher mortgage rates to reduce their risks. So while the Fed is trying to help the economy, it doesn't always mean your mortgage rates will drop immediately. Hey there, if you don't know me yet, my name is Shane Judge. I go by Judge, you can call me Shane, as long as you call me. I'm a professional real estate advisor serving the greater Las Vegas area. That includes Las Vegas, Henderson, North Las Vegas, Boulder City, and sometimes even Pahrump. I specialize in helping people just like you navigate the real estate market, whether you're buying, selling, or investing, or just exploring your options. My goal is to make real estate simple, empower you with knowledge, and guide you to make the best decisions for your future. And while you're here, don't forget to like this video, hit the subscribe button, and tap that notification bell so you never miss out on another educational video about the real estate market in our amazing Las Vegas area. I've got tons of valuable content coming your way, and I'd love for you to join my journey. By the way, if there's a topic I haven't covered in my content that you'd like to learn more about, drop it in the comment section below. I love getting new content ideas for potential real estate buyers, sellers, and investors. It helps me create videos that really matter to you. All right, let's get back into it. Now let's take a look at what's been going on with the 10-year Treasury yield over the past year. In January 2024, the yield was approximately 4.06%. 30-year fixed mortgage rate around the same period, the average rate was about 6.63%. By mid-September 2024, the yield had decreased to approximately 3.62%, marking a decline of about 0.44 percentage points from January. Correspondingly, mortgage rates dipped to around 6.2% in mid-September, reflecting a decrease of approximately 0.43 percentage points from January. Now, by January 9th, 2025, the yield had risen to approximately 4.68%, an increase of about 1.06 percentage points from mid-September. In tandem, mortgage rates climbed to around 6.91% by January 2nd, 2025, reflecting an increase of approximately 0.71 percentage points from mid-September. These changes reflect what's happening in the economy, like inflation fears, market optimism, or even global events. And remember, when the 10-year yields go up, mortgage rates tend to follow. Now, if you're still along for the ride and you're a little lost, let me give you an analogy to tie this all together. Imagine the Fed is driving a car. The federal funds rate is the gas pedal speeding up or slowing down the economy. The road conditions like inflation, investment behavior affects how fast the car can go. And the 10-year Treasury yield is the steering. It helps guide where mortgage rates go depending on the bigger picture, like if there's bumps or potholes in the road. So just because the driver presses on the gas pedal doesn't mean the car will move faster. It depends on the road conditions. So why should you care about all this? Because understanding this relationship is crucial for potential homebuyers and those looking to refinance, as shifts in the 10-year Treasury yield can serve as an indicator for future movement in mortgage interest rates. Staying informed about these trends can aid in making more strategic financial decisions regarding home financing. When you hear about the Fed cutting rates, don't assume it means mortgage rates will drop immediately. Instead, watch what happens with the 10-year Treasury yield and the broader economy. That's where the real story is. All right. That's it for today's breakdown. I hope this helped clear up the mystery behind the unsure common answer. It's because of the 10-year Treasury yield bond. If you found this helpful, hit the like button, subscribe for more real estate insights, and drop any questions in the comments. I'm here to help. Thanks for watching, and as always, stay curious, keep exploring, and I hope to see everybody on the next one.